A quiet shift is underway in North American energy flows. It is not driven by politics or headlines, but by infrastructure, contracts, and long-term capital decisions. Canada is redirecting a growing share of its energy exports toward Asia, a move that is gradually rebalancing how continental dependence actually works. Welcome to GeoCapitalist. Today, we examine how Canada's $15 billion energy shift toward Asia is rebalancing North American dependence, and why this change matters far beyond short-term trade discussions. This is a story about infrastructure, market access, and strategic optionality. If you value calm analysis on global energy and trade, consider subscribing. For decades, North American energy integration followed a simple structure. Canadian crude flowed south, refined primarily in U.S. facilities, and priced within a tightly connected continental system. This model created efficiency but also concentration risk. When market access depends on a single direction, pricing power and strategic flexibility narrow over time. That dependence was reinforced by geography, infrastructure, and regulatory alignment, locking producers into a limited set of outlets regardless of global demand conditions. Over time, this created persistent price discounts and reduced negotiating leverage. Recent infrastructure developments have begun to change that structure. Rather than replacing U.S. demand, Canada has added parallel pathways that reduce reliance on any single market. This distinction matters because diversification changes incentives on both sides of the trade relationship. Energy systems rarely transform overnight. They evolve through incremental capacity additions that gradually reshape bargaining dynamics, investment decisions, and contract structures. The result is not separation but optionality, the ability to respond to market conditions without disruption. As optionality increases, dependence decreases, not through confrontation, but through design. This shift marks a transition from vulnerability toward balance within an integrated continental system. The Trans Mountain Pipeline expansion, operational since mid-2024, represents a structural addition rather than a temporary adjustment. With capacity approaching 900,000 barrels per day, it provides a permanent outlet to Pacific export terminals capable of serving multiple overseas markets. Supporting facilities, including upgraded marine terminals and port logistics near Vancouver, enable consistent, large-scale shipments with predictable loading schedules and reduced congestion risk. These assets were not built for opportunistic price spikes or short-term arbitrage. They were designed for durability, redundancy, and long-cycle utilization. Once built, infrastructure defines trade behavior for decades because it shapes where capital, contracts, and logistics naturally flow. By establishing reliable westward export capacity, Canada has altered the geometry of its energy system from linear to multi-directional. Southbound flows remain essential and commercially significant, but they are no longer exclusive. This physical reality quietly reshapes negotiating leverage, pricing outcomes, and future investment decisions. Infrastructure does not debate policy, it enforces options. And those options underpin every strategic implication that follows. Asian demand has emerged as a natural complement to North American markets rather than a substitute. Refiners in China, South Korea, and India have incorporated Canadian crude into diversified supply portfolios through multi-year commercial contracts. These agreements are structured around global pricing benchmarks and long-term delivery schedules, reflecting operational integration rather than opportunistic buying. Once a refinery calibrates its systems to a specific crude grade, switching suppliers carries technical and financial costs. This creates stickiness that stabilizes demand over time. Importantly, these volumes remain a minority share of Canada's total exports, underscoring that continental trade continues. What changes is concentration. By serving multiple regions simultaneously, Canada reduces exposure to regional disruptions, regulatory shifts, or pricing bottlenecks. The effect is cumulative. Each additional contract widens the margin of choice available to producers. Over time, complementarity replaces dependency, allowing Canada to participate in global demand growth while maintaining deep North American integration. As these new markets absorb incremental volumes, the consequences are felt not only in destination diversity, but in how prices are set across the entire system. Historically, constrained export access imposed persistent discounts on Canadian crude, often tied to regional bottlenecks rather than quality. Limited outlets meant producers accepted lower prices to maintain flow. Expanded export routes alter this dynamic. When buyers across multiple regions compete for the same barrels, pricing increasingly reflects global benchmarks rather than geographic penalties. Even modest diversification can shift negotiations. Producers gain leverage not by withholding supply, but by having credible alternatives. Data from export contracts following the pipeline expansion show narrower differentials and improved realized prices, strengthening margins across the sector. This pricing effect extends beyond crude sales. Higher confidence in market access improves financing terms, stabilizes investment planning, and encourages longer-dated production commitments. Optionality becomes a pricing mechanism in itself. Over time, this reduces volatility and aligns Canadian revenues more closely with global market conditions, reinforcing the strategic value of diversified infrastructure. Pricing, however, is only one layer of impact. The deeper effects emerge inside Canada's economy, where diversified exports translate into structural resilience rather than short-term gains. Diversified energy exports generate tangible economic effects within Canada that extend well beyond headline revenue figures. Improved realized pricing strengthens federal and provincial royalty streams, while stabilizing cash flows for producers operating in capital-intensive environments. Export Development Canada data indicate that broader market access reduces revenue volatility, which directly improves financing conditions and lowers borrowing costs for energy infrastructure and upstream development. This stability matters because energy projects operate on multi-decade timelines. At the regional level, port expansions, terminal operations, marine services, and logistics employment have grown alongside Pacific exports, particularly in British Columbia. These activities create multiplier effects across transportation, engineering, insurance, and professional services. Importantly, diversification also cushions the economy against localized disruptions, whether regulatory, climatic, or market-driven. Rather than amplifying exposure to a single trading partner, diversified exports distribute risk across regions and cycles. The outcome is not an export boom, but economic resilience, a quieter, more durable benefit that compounds over time. As Canada's domestic exposure becomes more balanced, the implications extend outward, subtly reshaping how North American energy integration itself functions. North American energy integration is not unraveling, it is recalibrating. Cross-border flows, shared infrastructure, and long-standing commercial ties remain foundational. What changes is the asymmetry. When Canadian producers gain alternative outlets, continental integration becomes less compulsory and more reciprocal. This alters negotiation dynamics across pricing, capacity commitments, and infrastructure planning. Instead of reliance anchored in necessity, cooperation increasingly reflects mutual advantage. From a system perspective, this rebalancing enhances stability. Markets with multiple pathways absorb shocks more effectively than linear systems. For U.S. refiners and consumers, diversified Canadian exports do not remove supply. They reinforce the importance of competitiveness and coordination. For Canada, reduced concentration risk lowers vulnerability to policy shifts and bottlenecks. Integration evolves from dependence toward equilibrium. Over time, this encourages more durable cooperation, where shared interests are reinforced by choice rather than constraint. Yet the most consequential changes rarely appear in trade statistics or policy debates. They are embedded in capacity decisions that quietly shape future behavior. Short-term supply figures often dominate public discussion, but they rarely capture where strategic power actually shifts. Capacity does. Pipelines, terminals, port logistics, and shipping contracts determine future behavior long before volumes visibly change. Once capacity exists, capital and contracts align around it. Producers plan development, refiners secure feedstock, and financiers price risk accordingly. These decisions lock in patterns years ahead of demand cycles or policy debates. Canada's westward export capacity illustrates this dynamic clearly. Even when southbound flows remain steady, incremental growth follows available routes. Over time, this reshapes expectations. Buyers adjust procurement strategies. Investors reassess regional exposure. Markets internalize optionality as a permanent feature. By the time headlines notice a change, the underlying structure has already shifted. This is why capacity, not rhetoric, defines long-term leverage. It quietly sets the boundaries within which future negotiations, prices, and partnerships operate. When capacity reshapes behavior at this scale, its effects extend beyond economics, influencing how countries position themselves within broader geopolitical systems. This reorientation of Canadian energy exports is best understood as a structural evolution rather than a political response. It reflects long-cycle planning aligned with global demand growth, infrastructure timelines, and capital discipline. No single policy announcement or trade dispute explains it. Instead, the shift emerges from cumulative investment decisions made over years. Canada's appeal as a supplier rests on stability, regulatory clarity, and reliability, attributes increasingly valued in global energy markets facing disruption elsewhere. As capacity expands and contracts mature, Canada's role within international energy systems deepens without undermining continental ties. North American integration continues, but within a more balanced framework. The result is a quieter form of influence, exercised through design rather than declaration. Over time, these structural choices shape trade relationships, alliance dynamics, and investment flows far more decisively than any short-term negotiation. Taken together, these developments reveal how modern economic power is built, not by breaking systems, but by redesigning them from within. Canada's evolving role in global energy markets illustrates how power shifts in the modern economy, not through confrontation or sudden disruption, but through infrastructure, contracts, and long-term planning. As this analysis has shown, how Canada and Asia's $15 billion energy shift is rebalancing North American dependence, not by weakening continental ties, but by adding strategic optionality that reshapes incentives on all sides. This approach strengthens resilience, improves pricing discipline, and reduces vulnerability to regional constraints without undermining cooperation. Over time, these structural adjustments will influence investment flows, supply security, and economic relationships across North America and beyond. If you want to continue exploring how infrastructure and long-cycle strategy quietly reshape global trade, watch this video next. Thank you for watching, and see you in the next video.